Welcome back to the Deep Dive. Today we're jumping straight into IAS 39, Financial Instruments, Recognition and Measurement.
Yep, that's the one.
Our mission here is really to get a handle on its core ideas and how it's evolved. We've got some historical context to guide us.
Exactly. And fundamentally, IAS 39 is all about how companies account for their financial bits and pieces, assets, liabilities. It's pretty key.
So let's talk history. The IASB International Accounting Standards Board, they adopted it April 2001.
That's right, 2001, but it actually originated earlier with the IASC.
The predecessor body.
Yeah, the International Accounting Standards Committee. They issued the first version back in March 99. It replaced bits of an older standard, IAS 25, from way back. Shows how things change, doesn't it?
It definitely does. And it wasn't static after 2001 either, was it? Lots of tweaks.
Oh, absolutely. A major revision hit in December 2003. That one was important because it added implementation guidance, helped smooth things out,
Consistency across the board.
And then came a whole series of amendments for specific problems.
Like what? Give us the highlights.
Well, March 2004, there was stuff on portfolio hedging for interest rate risk.
Okay, hedging a whole group of things.
Exactly. Then June 2005, updates on the fair value option. July 2008, more guidance on applying hedge accounting itself. It kept evolving.
Portfolio hedging sounds quite practical for managing risk.
It is, definitely. Allows a more holistic view. Later, October 2008, they tackled reclassifying financial assets. And March 2009, measuring embedded derivatives.
Embedded derivatives.
Yeah.
Those tricky bits hidden in contracts.
Precisely. And around that time, disclosures got shifted too.
Oh, where did they go?
August 2005, they moved the disclosure requirements over to IFRS 7. It just focused on disclosures, made things a bit clearer, really.
Right. Keeps things organized. Now, fast forward a bit, the interest rate benchmark reforms, that must have impacted IAS 39.
Big time. Yeah, September 2019 and August 2020 saw amendments specifically for that. Think LIBOR replacements and all that uncertainty.
So, like, temporary relief for hedge accounting.
Essentially, yes. Provided some exceptions because the whole market was shifting under everyone's feet.
Okay, so bringing us to today, where does IAS 39 actually stand now? I thought IFRS 9 was the main standard.
It is. You're right. IFRS 9 has largely replaced IAS 39. But, and this is the interesting part.
There's a but.
There's a but. Companies can still choose to apply the hedge accounting rules from IAS 39 if IFRS 9 allows it for that specific situation.
So it's not completely gone. There's an option for hedging.
Exactly. IFRS 9, specifically paragraph 6.1.3, gives permission to use the IAS Company 9 hedge accounting approach for fair value hedges of interest rate risk in certain portfolios.
Got it. So hedge accounting is where IAS 39 still has its main foothold.
Mm-hmm.
What are the core concepts we need to grasp there?
Okay, key terms. You've got the hedging instrument. That's usually a derivative, the tool you use to offset risk.
Like an interest rate swap or something.
Could be, yeah. Then there's the hedged item. That's the asset, liability, future deal, whatever, that's exposed to the risk you're trying to manage.
Right. Instrument hedges the item.
Precisely. And then the crucial bit, hedge effectiveness. Basically, how well does the instrument actually do its job of offsetting the risk in the item?
So you have to measure how well the umbrella works, not just carry it.
Good analogy. Exactly. And there are different types of hedges, too.
Oh.
Fair value hedges, protecting against value changes. Cash flow hedges, protecting against variable future cash flows. And hedges of net investments in foreign operations.
And what hoops does a company jump through to actually use this hedge accounting under IAS 39?
Few conditions. Formal documentation right at the start is key. You need to show you expect the hedge to be highly effective.
Prove it up front.
And be able to measure that effectiveness reliably. Plus, you have to keep checking it actually is effective on an ongoing basis.
Makes sense. And the accounting treatment, briefly.
For fair value hedges, the gains or losses on both the hedging instrument and the hedged item linked to the risk generally hit profit or loss.
Okay.
For cash flow hedges, the effective part of the gain or loss on the hedging instrument goes into OCI first, other comprehensive income.
Got it. And those benchmark reform exceptions we mentioned.
Right. They basically allowed companies to assume certain things about the new benchmark rates when checking effectiveness and probability, just to keep the hedge accounting going during the transition, ease the pressure a bit.
Okay, so let's try and wrap this up. What's the big picture on IAS 39?
Well, it's had quite the journey, hasn't it? From being the main standard for all financial instruments to now having this more focused role, mainly in hedge accounting.
But still a relevant role.
Definitely. While IFRS 9 is the primary standard, IAS 39's hedge accounting rules remain a valid option, sometimes even preferred, especially for those portfolio interest rate hedges. And it's shown it can adapt, like with the benchmark reforms.
It really makes you think, though, with financial markets always changing and accounting rules trying to keep up, how will these hedge accounting ideas need to evolve next? What new reporting challenges might pop up? Something for you to ponder.
Absolutely. Constant evolution.
Thanks for walking us through that. That was a great deep dive.
Thanks for diving deep with Deepcast AI today. If you enjoyed this, give us a like and definitely subscribe and ring that notification bell so you're first in line for our next exploration.